All right, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The tech trade leading today, but not so much lately. We will debate the road ahead for that sector, what it means for the markets at large. Joining me for the hour today, Joe Terranova, Kerry Firestone, Amy Raskin, Steve Weiss. We will check the markets. I said tech is leading today. I mean, the Nasdaq's positive. The other two majors are in the red, as is the Russell. And the fact of the matter is, Joe, aside from one day last Thursday after the Fed, the markets really haven't done all that much since you got the rate cut. And tech really hasn't done a whole lot. And maybe that's one of the reasons why the whole thing hasn't done much.
Well, I do think the Mag 7 have had a nice price recovery since the Fed announcement, and it's really been about NVIDIA coming back once again. The concern that I have is that it seems as though we've got to sell the news moment. I've spoken about this in the last several days for the Russell 2000 index. What should have happened has not happened. Now, let's keep in mind something else. You've got this steepening that's going on with the yield curve. The 2 to 10 spread is out to 22 basis points. That is the steepest that it has been going back to May of 2022. In that environment, financials should be doing well. This should be benefiting regional banks. Small caps should be doing well also. So I'm somewhat troubled about the price performance of the last several days because I think we need the Russell. I don't think we can get away in the coming quarter with just relying on the Mag 7 to have that concentrated performance once again. I think we need full participation once again. I think we need the script to look a lot like it did in the third quarter where the S&P was up 5%. The NASDAQ 100 only gave you 2%. The Russell gave you 8%. And equally weighted was particularly strong. Financials participated, consumer discretionary, utilities, and real estate. We need that script in the fourth quarter.
So in a month, in the last month, Kerry, the equal weight is up 2.2%. The S&P is up less than 2%. That speaks to the fact that tech has kind of dropped off its leadership role. It may still be doing just fine, but it's not outperforming to the degree that it was by any stretch, and thus the market seems to be held back by that.
Well, Scott, what we're seeing in this market has been a recovery from the early August lows, August 7th. The NASDAQ up 11%, the S&P up 6.5%. And right now, if you look at the top 10, I often look at the top 10 of the S&P, they're trading at a multiple on 2025 earnings of 26 times. And what we could say until the last month or two is that the rest of the market, the other 490 names in the S&P, were not selling at a very inflated multiple, that they were really attractive. But they've moved up a lot. The rest of the S&P 490 names, that's selling at 19 times 25 earnings. The market's almost 21 times next year's earnings. So where is there a cheap part of the market? It's really hard to see it. You're not getting it from the financials. They've moved up. You're not getting it from the industrials. You're not getting it from healthcare. They've had some move. So is there a way for these top names to move higher? I think they've got to prove it with earnings, and this earnings period is going to be tough.
Okay, I'm glad you framed it that way, because it's Weiss, what Rick Reeder talked about with me the other day. The idea that a lot of areas of this market are crowded. A lot of sectors have done really well. So that's why he says, well, I like equities, but you're not going to get that huge of a return because, I mean, everybody's in everything. Where are you going to lean into? Where should you lean into?
In the market, where should you lean into? I think you stay where you are. To me, it's not which area of the market, it's which stocks in the market am I comfortable owning. I don't think the market's cheap. I don't think it's giving you anything. But I've heard tech is a crowded trade, frankly, since I've been in the business, and that's over 30 years. It's always crowded. And you know why it's crowded? Because it generally has the best fundamentals. It's got the best balance sheets. It's got the best, the best products. I mean, and it's got the best market share.
Kerry's point is, like, a lot of things are crowded, right? Forget just tech. Industrials are crowded.
Right.
They've been trading at near record highs.
Tell me CAT's not crowded.
Utilities, are they crowded?
All-time high.
Yeah, I mean, CAT, on fundamentals that have yet to be proven out in what is a slowing economy, make no mistake about that, the economy is slowing, that CAT's hit an all-time high with still being as close as you could possibly be to a restrictive monetary policy. So I don't get it. So I think that, when Joe says what the market needs, here's what people need. They need to relax, not focus on what's leading today, what's leading tomorrow, what's led for 3 weeks, what's going to lead for the next 3 weeks. Focus on bottoms up fundamental analysis and stay with those. There will be volatility, don't sell the position because it gets a little bit out of control in terms of the upside, because it will grow into that valuation. Obviously, there'll be volatility. There'll be days where you say, why do I own this? Why didn't I sell it? It's so far ahead of itself. You'll say, hey, why didn't I sell it? Because it's down 30%. Just take it easy. You've got a lot of news to go through over the next 2 months.
I think it surprised some people, Amy, that the market's been reasonably muted, though we've been hitting these new highs on the Dow and the S&P, albeit with modest gains every day since the Fed did their jumbo cut. Right? For some, that was the time they were waiting for, okay, I'm going to lean in a little more now to this market. Now you got the cut, and people aren't exactly leaning in.
Well, the cut wasn't exactly a surprise, though. I mean, we waited.
50 might have been.
Right. 50 was a little bit of a surprise, but I think at that point the market needed 50. So I was happy that they did 50. I think some people were thinking maybe they should have even gone in July. So I actually think the cut wasn't such a big surprise. The market was expecting a cut. They're still expecting more. We still need more. As Steve said, monetary policy is still restrictive, and the market's expensive. So I agree. There aren't that many, great opportunities, particularly in U.S. equities. I mean, we can talk about this, but we've been shifting more of our portfolio abroad, where things are much cheaper. And, in many areas, they've started cutting even before we started cutting, which is kind of the first time that's ever happened. And there are attractive opportunities at good valuations. I mean, just look at Accor versus Marriott. Like, they're in the same business. They have a lot of the same trends, once at a much cheaper valuation. And so you have some of that downside protection a little bit.
So you'd rather look overseas for value than go into the, let's just for argument's sake, say the 493.
Yeah, I mean, we own U.S. utilities, but Kansai, the Japanese utility, data center growth and electric demand is increasing in Japan, just like it's increasing here. They have a nuclear fleet that, again, nuclear is going off the charts here, but not people just aren't focused. It's 6 times earnings.
The biggest debate seems to be whether to lean into these other areas. You say, well, we need the Russell. Amy said, I mean, we're still restrictive on rates. There's still questions about the economy. How are you going to buy the Russell with confidence? Let's just say that, with confidence.
I'm not buying the Russell at all, because I'm not confident.
How's anybody going to buy it with confidence, given where the environment is? You still have restrictive rates. Rates were higher, today than they were pre-cut, at least 10-year, 30, like things like that. And they have still questions about the economy itself.
Yeah, I completely agree with your assessment. I still think we're in an environment where sentiment is leaning somewhat towards being defensive. And a lot of what technology leads you towards ownership of defensive equities. You can make the same argument for large caps.
Why isn't it working better then? Right?
Well,
that was a defensive trade for a large part of the period of time where the Fed was still raising rates, and even when they stopped, right, and they just stood pat for a long period of time. That was the trade that worked because it was deemed to be defensive. Why is it slowed down now?
I think a lot of the reason that we saw the slowdown came from the early August, quote unquote, liquidation that we saw. I think that there was extreme positioning in a lot of those Mag 7 names. I think that positioning got worked off aggressively, and capital went into other areas of the marketplace, and that capital was treated well because the Federal Reserve was going to give you a 50 basis point cut potentially, and they delivered on that. Now, you get the 50 basis point cut, and you should have the response to that. You didn't. That's why I say I'm concerned that was a little bit of a sell the news moment. Look, I agree with Steve, by the way. I think we're fine. We're in a secular bull market. I think, though, if you look at the upcoming quarter, I don't think anyone would be bothered with an upcoming presidential election with a lot of geopolitical tension and with difficult earnings coming up if we came out of this quarter basically unchanged. I don't think anyone would be bothered by that.
Difficult earnings coming up because the multiple of that's the whole key to the whole thing.
That's the whole key to it. But the comps get harder in this quarter. The comps get much harder for a lot of areas of the market, in particular software and semis. You got tough comps coming up.
I was going to say that this quarter, just since the beginning of the quarter, meaning July 1st, estimates were 8% up for the S&P, and now they're at 4.6% up on the S&P.
And
then,
always the case, isn't it?
No, not to that extent. And then it starts to really heat up in the fourth quarter, and next year is supposed to be up 15%. That's just crazy. So we really have to start to feel better about those numbers. Even if the numbers aren't great, the guidance has to start to look better.
So you made some moves. We're talking about tech. You
Yeah.
trimmed Adobe and you bought more Autodesk.
Yeah, I would say that move, and it's, portfolio management. Our Adobe position was fairly large. It had come down, then it came back up. There's questions about whether they're going to be disrupted by all types of AI or innovation that's into their space. And Autodesk, on the other hand, just started to recover. It's having a really nice move, and it's construction based, and that looks to us as if interest rates will help it on the commercial side too.
Do we think the markets can continue to rise? We know we have the election and we expect volatility. Without tech resuming its leadership role, can we continue? Can we hit the kind of targets, the 6100s, the Brian
It will be
Belsky
very difficult.
target, or some of the other really bullish targets like 6200, 6250? I've heard from certain technicians as well.
It could happen, but it would be very difficult just given the weight of tech in the S&P at this point. So if the other 70% of the market would have to move a lot, which, the economic backdrop doesn't really lend itself to, that happening. So I think it's difficult.
Because you're starting to get some more cautious notes too from the street, Weiss, about big tech and research analysts. Alphabet, the target cut to 185 from 210. That's at Oppenheimer. They're talking about the DOJ, regulatory issues creating uncertainty there. So what do we make of that, right? Everybody's been chasing these stocks. And for the most part, the whole way up, it was, okay, X analyst raises price target.
Right.
Y analyst raises price target. Next week, got another price target raised because they've been chasing and they were too low and they missed. They keep following it up. Now you got some pulling targets down.
Yeah, you do, and not only in techs, we've seen, the auto sector, which I assume we'll talk about later. Amy and I were just talking about this with Alphabet. It's actually today my largest position because of comments like that. It's going to take years for anything to come out in the antitrust front. And we've seen this over and over again for the last, decade or so? We'll see it again on Meta. We'll see it again on Microsoft. We'll see it again on Apple. So that doesn't concern me. And it remains to be seen, frankly, if they force these companies to break up, which they won't, if the sum of the parts will trade greater than what we see as the whole now. So I'm not concerned about that. I like the negativity on the street on Alphabet. It's been correct. I don't think anybody's been chasing. They've been chasing the door. So I'm comfortable being there.
But
Now, it's not going to stay as large a position as it is right now, but it's somewhat unresponsibly large, frankly, in the portfolio.
These
So we'll
companies,
see.
before they started pulling back, have had multiple expansion.
Yeah.
Right? That's primarily why the stocks continue to go up, is through multiple expansion.
Yeah.
Their whole note sort of culminates with the idea that their forward PE should be capped at 20 times. That at some point, you can't just continue to have multiple expansion after multiple expansion after multiple expansion.
Correct. They haven't had multiple expansion.
Not
What's
really.
their forward PE?
Forward PE, I was looking at the other
20.
day.
No, it's about
I think
20.
it wasn't
Okay, so
discounts on the market.
It's a 20.
Yeah.
Right. It's like discounts on the market. So you're telling me that a company that owns search, has a phenomenal advertising model, that has a fortress balance sheet, that has been an innovator over time. Look at Waymo, look at everything else. You're telling me that company with a relatively predictable earnings growth and EBITDA growth should be selling at a discount to the market?
Aren't you concerned, though, what artificial intelligence is going to do to search? And remember, I'm with you. I own Alphabet.
Right.
Are you concerned about that?
I think about it. Right now, I'm not all that concerned about it because if it's going to drive search, it's going to drive Google.
Strength for them.
Yeah, but
So
the
they'll
whole
be able
point of
to
the whole point of the
It's a lower
DOJ,
return.
the whole point of the DOJ action is because the potential of the monopoly issue.
You know what the DOJ's
Against the
track
very-
record is in court? It's
So
not
you
very
just
good.
discounted the whole thing?
It's not. No, I'm not discounting it. I mean, that's why the stock.
This whole note talks about not only that, but discounting the loss of the exclusivity with Apple. You put those two things together, and that's why the multiple's capped at 20.
Right.
Also, right now, the economics of an AI search is very different than the economics of a traditional Google search. So I think that's one thing that people are worried about. How much money are they going to spend on AI? Is that going to really impact the cash flows and what they are going to return to shareholders in dividends and buybacks? And that, to me, is the bigger concern.
But how does it not cannibalize Alphabet's search
Right, no,
model?
and even if they get
Joe,
it, it's
here's
at a
how.
lower margin.
Because they have not perfected search, okay? And they have not perfected advertising. So the innovations to the advertising model will drive more revenue at ultimately lower cost because they'll leverage the money they spent on AI. It cost $100 million plus to build a large language model for AI. How many companies do you think have the ability to do that?
Well, what about the ones that already have? I mean, like, well, you don't think that some search is going to go to, I don't know, OpenAI or
Perplexity.
ChatGPT or Perplexity, which is already making those kinds of deals?
I use Perplexity. I think it's good, but look at it this way. Microsoft for years, okay, with a very large balance sheet, with an incredible installed base, with Bing on there on everybody's desktop, right? What'd they do in search? They gave up, right? They still have a product. They
This
gave
is different, though, Steve. Apple Intelligence is not going to disrupt
Apple
search.
Intelligence is a marketing name. We know nothing about Apple Intelligence. And do you think Apple's going to have their own search engine? No, Apple's a great marketer.
I'm
but
just
it's a
saying,
poor
like,
innovator.
places, AI platforms like Perplexity are already planning to start running
Yes.
ads. So what
Right.
was a duopoly, essentially, between Facebook and Alphabet, in many respects, around search and advertising, is not anymore.
I'm not saying there's not risk to it. What I'm saying is I'm comfortable with the risk at the current price, given their business. And that's going to take a long time to grab hold. I use Perplexity. Somebody in our office said, hey, you got to look at Perplexity. I used it, and I found it to be okay. I didn't find it to be superior to Google.
Well, what market share do they have? It's going to be in the mid-single
Like
digits.
non-existent.
Yeah, like nothing. So it's got a long
Actually,
way to
it's actually
go.
not
It's-
that-
Look at
yeah.
it this way.
Right.
Apple and you know, let's not go back and forth from this. It's just fact. They don't innovate. Despite them not innovating, because they have an installed base, they've got a moat around them. Same thing with Google.
Well, we'll get more information on Meta today regarding AI, presumably, their developers conference. It's their Connect conference kicking off in less than an hour. That's out at Menlo Park. Julia Borston is there and can give us a little walk up to that and plays right into the conversation, Julia, that we're having here.
It does, absolutely, Scott. Today, I'm here at Meta headquarters where CEO Mark Zuckerberg will be giving developers and investors a look at the company's innovation roadmap. And nearly 3 years after the company rebranded from Facebook to Meta, virtual reality will be one of the key areas of focus. We expect Meta to unveil a new Quest headset, reportedly at a price point hundreds of dollars lower than the current $499 high-end version, as Meta looks to drive mass adoption of its VR technology. Now, Meta's investment in AI will also be a focus in two key areas. It's expected to unveil new generative AI tools for advertisers, which analysts say could drive return on investment and revenue growth. And for developers, we could hear more about what's next from its Llama open source AI model. Now, the big wild card today is what augmented reality innovation Meta showcases after last week Snap demoed its new augmented reality spectacles. And with Meta's Ray-Ban AI smart glasses issuing a series of updates in the past year, and Mark Zuckerberg saying that they're selling very strongly, we're looking to see when these Ray-Ban smart glasses and other AR technologies start to merge, when they start to integrate augmented reality. And Scott will be hearing from Mark Zuckerberg. He's speaking at the top of the hour. Then we're going to be sitting down in an exclusive interview with Meta Chief Product Officer Chris Cox. That's coming up in the 4 p.m. Eastern hour. Back over to you.
Good stuff, Julia. Thanks so much. We'll look forward to that a little bit later. Julia Borston, Menlo Park for us. On the Meta issue, Joe, Jeff DeGraff suggests that there's been a buyer's frenzy. Those are his words. And that you should let some of the excess enthusiasm run off before you jump back into this thing.
That's fair. I don't disagree with that. I mean, certainly you could see a little bit of a price correction. In Meta, wouldn't be surprised by that. The stock is up nearly 13% in the quarter. We're talking about Alphabet. That stock's down 11% in the quarter. So mean reversion happens all the time. I do think, though, this is a company that is proving itself, and it's proving itself to the degree in which its revenue growth is going beyond some of the others. We talk about Alphabet. Again, I'm long Alphabet. I want it to work. I'm with you on this, Steve. But Alphabet, over the last year, has grown its revenue on a quarterly basis, an average of 15%. That's well below what we're seeing from Meta, which is growing at 27%. So there's justification for why Meta now has a richer valuation than companies like Alphabet. And I would just urge the viewers, if there is a price correction, I think you lean into it. Maybe you don't chase it here, but I think you lean into the price correction because I think they have some secular tailwinds behind them.
Anybody getting at all concerned about Apple in any way? Stock's
No.
not reacting all that much. Weiss, you sold it a couple weeks ago.
Yeah,
but the
I
lead
still have
time
some
notes, the
fairness.
demand around the 16 launch, you just go back to anecdotally, right? The eyes of our own technology correspondent, Steve Kovacs, like, you know what? I've done a few of these things now, and this line's dissipating shorter than it ever has in my memory. Then you get some research analysts who come out with notes on, New Street says we expect a 10% miss on iPhone 16. It's an increasingly concerning wait time gap at the high end. Morgan Stanley's Woodring, lead times tracking lower.
Yeah.
Right? Again, like you don't get a confluence of sort of negativity usually with Apple.
Right, that's fair. And look, you don't know what Apple Intelligence is. You don't know if it's just a marketing name or if there's some meat in the bone there. And you also don't know what you're going to be able to do or want to do on your phone, right? It's a very, it's limited utility, much more utility than it had decades ago, but it's still limited utility. So the way I look at Apple is that I've got Google growing at 15% quarter to quarter. I've got Apple not growing. I've got Apple at a 30 multiple, and I've got Google at a 20 multiple. So Apple, to me, is overpriced, and what you never price in, and maybe it happens one day, it's more than a zero chance, that the telcos say, you know what, we're all competing against each other. We're giving out our CapEx. We'd rather buy back our shares. Let's stop giving everybody free iPhones. I mean, it's lunacy at this point to do that, right? So that's ultimately the bomb for Apple. So I think you've got to risk manage that in terms of it's got to be input to your analysis. And if you get to decide a probability, is it 10%? Is it 20? At least you got to think about it.
The first iteration of Apple Intelligence is via the iPhone 16. I think it's foolish to say, okay, we're going to make the referendum on success or failure on how many iPhone 16s we sell. I think what we'll see is the evolution of Apple Intelligence as a software product that will be delivered onto your phone through the course of time. I think they're going to achieve success in that.
But the point is, it's a wait and see attitude for consumers.
I agree
So
with
that's
that.
why the
Well,
disappointment will continue.
No. But wait a second. What do they always do in the interim? In the interim, while you're sitting with the wait and see, they are aggressively buying back their stock. People might not like that degree of financial engineering, but that's what it is. So
You
you're
don't pay
getting
30
paid to wait.
times for financial engineering.
I'll pay the 30 times. I'll pay to wait for the advancement of the software. It's the software that's so critical in where Apple Intelligence is going to go.
Do you think it's going to bring new people into the Apple ecosystem? Like, do you think it's going to cause people to move from their Android phones to their Apple phones?
No, it doesn't.
No, I think it's just an upgrade.
It doesn't have to at all.
But it's just an upgrade cycle that's accelerated, like still 30 times for that. Like if somebody was going to buy a phone 6 months later and they buy it 6 months earlier, how much are you going to pay for that?
I don't think it's an upgrade cycle to the degree that we saw the 6 when it came out with the larger size iPhone. I think it's an upgrade cycle that sequentially happens over multiple years. I think you'll see that.
But
for
the
this
market
company.
is priced that Apple continued to gain share.
Hey, by the way, Kovac is listening to our conversation and says, tell Weiss no free iPhones. Quote, carriers may offer them for, quote, free, but they eat the cost up front and you pay it back over 2-3 years. Apple still collects the money.
Tell Kovacs that.
Kovac.
Kovac.
Get the name right.
I should
right?
use perplexity to get it.
He didn't say Weiss.
Tell
He said Weiss.
Tell Kovac, okay, that the consumer believes they're getting for free. The money out of their pocket is free, right? They get the phone. They sign for a new 2-year agreement. It's free. If he could find that there's no capital expenditure or line in the telco statement that shows that they're not supporting the iPhone, I'd like to see it.
Okay. Well, you stay tuned. I'm sure he's
Typical
listening.
tech guy.
I'm sure he's listening. And if he has a response to you, I will be sure to read it
Can I
to
make
you,
one
either on or
comment?
no. I got to go to break.
Okay.
Up next, calls of the day. We have a big sell call on the stock both Joe and Amy own. We debate that next. Calls of the day. We start with Apollo here. Initiated outperform. 139 price target. Wolf Research. Joe, you own that.
Stock made an all-time high on September 23rd. CEO Mark Rowan doing a fantastic...
Rowan.
From Long Island.
Is
Okay?
anybody like,
He
I
said
mean,
it.
I'm from
rowing?
Long
You said
Island.
rowing.
Okay, I'm proud of where I'm from.
He said Kovacs.
Okay.
I thought there were more.
You never say anything wrong?
I'm on my job description. I have to correct that. Let's go.
Okay. $5 billion facility from BNP Paribas. Credit facilities being established. The target for Mark is 250 to 300 billion in volume, packaging his loans, mortgage loans, auto loans, into aircraft loans, into the private credit facility, and investors, both institutional and retail, desire it.
All right, good stuff. Cadence initiated underperform. Amy Raskin at Oppenheimer. You own that stock, correct?
I do, and look, it was a $50 stock a few years ago, so this stock doesn't owe me anything. We've trimmed it all the way up. It's still a decent sized position. I think they're really well positioned from a longer term perspective, but I can't argue that the valuation is cheap here.
What's your take on Verizon while I got you? Because
like-
the target got raised by Citi just by a couple bucks.
Yeah.
They reiterate they expect good volumes in financials.
I like Verizon a lot. The chart looks great. The Frontier acquisition was smart. I think they're not, I don't think, as Steve was saying, I don't think they're doing, as stupid things as they used to do with, just using all their CapEx to give phones away. I know, to Steve's Kovacs point, that they get it back in with the service, but it's a more rational telco environment now, and I think that accrues to their benefit, and the stock's really cheap.
Okay, Expedia cut to hold from buy. Joe, take that. Price target goes to 150 though from 130. Makes sense why you go to 150 from 130 if it's at 146. They see balanced risk reward.
A little troubled with Expedia. We've had 3 earnings misses so far this year. Prices recovered each time. They've been really unable to establish any degree of fundamental and technical momentum. You're seeing difficult comps as well ahead for this company, and the consumer business is getting somewhat challenged. So at the end of October, obviously, the rebalance and reconstitution, we'll take a look at.
All right, I still have no takers on Nike, correct? On this desk, Amy, you sold
sold out of it.
in the spring.
Yeah, we sold-
The target got slightly raised at Morgan Stanley to 82 from 79. But they say they're still on the sidelines.
I do think they needed to change the CEO, so I think that was a good move. But now, we have to wait and see what happens next. They've just lost so much market share.
They report earnings next week. They have to go one step further. They basically have to lower all the expectations for
Yeah, they have to
2025.
slash
And the
everything.
new CEO has the opportunity to do
that,
that.
yeah.
And he should.
was the right
just
move,
kitchen
yeah.
sink the whole thing.
They should,
Yeah.
absolutely. Set the low expectations for
Were you
2025.
sure
But they
into it?
need new product.
No.
Were you short into the report?
No, I'm not touching it. I
Yeah, but it's
took
been
my
a
pain.
big move higher. I mean, it's really, now they got to show you.
Come on,
Worth it.
Jose, step up. We
Kind
can
of
touch
only,
that.
there's kind of only one way to go at this
Right.
point for that, right?
I don't know about that. I mean, if the stock has moved up 50% and it's all an expectation that something good is going to happen, then, something has happened. They've got a new CEO. If nothing produces over the next 6 months, then they take down guidance, then I'm not
Well, nothing's
sure.
going to change in 6 months. I mean, the
Well, I
whole-
understand, but the stock has. I'm just saying the stock came down for good reason because they kept
Delivering.
missing.
They didn't change the CEO in front of the report because they thought they were going to blow out the quarter. So I don't think it's a good time to get in. And plus, their merchandise is already designed. It's already going through the supply chain.
gonna take a
It's going to
while.
take a while working out.
Up next, another committee move to tell you about. Amy just trimmed a big consumer name. We'll tell you what it is next. All right, let's talk about this move from Amy. She trimmed LVMH.
Yeah, we trimmed this a little while ago, a little higher than it is now. Look, it has been a terrible stock all year. The luxury space is just struggling. We think that continues. There's just not a lot of pent up demand. You had all the aspirational buyers during the pandemic when everybody felt flush, and just given where the consumer is going, we just don't think, we just think it's going to struggle here for a little while.
All right, so this week, Estee Lauder
Yep.
up 8.5%. LVMH up 4%.
Right.
Why?
Well, that's the China.
Because of China.
Right. So if
You didn't
we-
mention that at all.
Right. Well, I mean, China has been weakening, slow for them for a long time. I mean, if we do get a big recovery out of China, this will work. If we do get a lot of stimulus in China, this will definitely work.
Well, what do you
So-
mean if? We are getting.
Well, we've had
Is
a
that the
little bit of
turnaround?
we've had
Is
a
that the
tiny,
turnaround?
Right. It's if this continues. I said, they made a big move this week. Very happy to see it, but everybody's been expecting that for a while, and the stimulus has been underwhelming to say the least so far. So it's a big economy to turn around.
I guess by asking the question, I'm suggesting whether the worst is behind these kinds of stocks, whether it's Estée or LVMH. They're down substantially year to date as a result of China concerns, clearly.
Yeah, I don't think China comes, just even with the stimulus this week, I don't think China comes roaring back. There's still such a feeling in China of we don't want conspicuous consumption. I don't think that the move this week changes that on a dime.
Okay, well, let's talk about some other stocks that are on the move today. Carrie, Salesforce. They bought Zoomin, data management provider, $450 million. What do you think? Price target, by the way, on Tuesday got Piper Sandler, to 325 from 268 as they upgraded that stock to overweight.
Yeah, I think it's a tuck-in acquisition. That's very small for Salesforce. The stock's been trending higher. It's sitting in its 200-day moving average right now. That's a good sign. If it can break it, it sells at 20 times earnings, so it's at a discount to the market. This is one of the lower multiple stocks in the whole software space. That's a growing company. It's growing, and revenues we think are going to start to pick up. So we like Salesforce here.
Okay, Cintas, they raised. Joe, new record high for a stock that you own in the Joe T.
Strong organic growth, operating margins strong as well. They exceeded very high expectations here. The commercial uniform segment performing particularly well. I saw some analyst notes. I saw one analyst note that actually has this at an underweight. I'm not understanding exactly why that is. And also, you had a recent 4-for-1 split on September 11th, which I think opens the opportunity for more investors.
Straight ahead, your best option. Bill Baruch's back. He's going to tell us how he's playing Micron into earnings in overtime as a new trade. He'll tell you what it is next. All right, welcome back. Micron down more than 30% over the last 3 months alone. Bill Baruch, though, says it's poised to trade higher following its earnings tonight in OT. He joins us now with his best option trade. What is it?
You know, I love this name. I love Micron. It's in our portfolio. It's about number 15 of 30 to 35 names, and it's beaten down. This traded above 155 earlier this year, and then fell into the 80s, got basically cut in half. A lot of negative downgrades, really flushing out that negativity. In fact, as one of my final trades last week, the PC and memory cycle, it's this very cyclical business. And that's one of the reasons why it's been downgraded and negativity around that. But the AI introduced in the chips and refresh cycle for smartphones and PCs, I think is a tailwind here. But most importantly, it's the high bandwidth memory, which they're sold out of in 2024. They're likely going to be sold out in 2025, and their partnership to NVIDIA. With this stock below 100, I think there's really good tailwinds that they can have a good report and trade higher. They don't need a blowout report. So I've gone out to December 20th, and I've bought the 110, 125 call spreads. It's costing me about $2.75. I started buying these on Monday, added more today. And going back to that back of napkin math, the cost of this at $2.75, it's a $15 wide spread. I divide that into 15, and it's 5.5. I want that number to be above 4 for good value or solid value in an option trade.
All right, well, we shall see. Thank you very much for your latest best option. I appreciate that. CarMax is also, Carrie, reporting too.
Yes,
that's
exactly.
Yours?
So 85 cents is the number. We think they can do better than that. This is an industry that's really suffered because the price of used cars was so high, and it's starting to come down. It has for the last few quarters. That's going to be good news. You've got interest rates coming down, and we think that this is the time that the industry is going to start to accelerate on volumes.
Okay, we shall see on that too. Up next, winners and losers. We'll tell you what they are next. Let's highlight some winners and losers for you, if we could. HPE, Hewlett Packard Enterprise, is up near 5% today. That was upgraded today to overweight from equal at Barclays. It's currently leading the S&P as well. And Vertiv announced yesterday a major expansion of its North American manufacturing operations. You added to that the other day.
Correct? I did. I've added to it a few times. Nice add, 250,000 square foot facility, I believe. Look, an insatiable appetite for what they do, and it's a pure play for data centers. They make the cooling racks, and you need cooling racks because AI search runs 20 times as hot. So, which means that the supply chain, of which they're part of, obviously, runs 20 times as hot. So I like it. I think I sold it last time about 103, 104. I'm going to ride it a little longer this time.
What do we think about Adam Jonas today? Anytime that the influential Morgan Stanley auto analyst makes a move on a stock, we talk about it. Today he downgraded General Motors to sell, Ford to hold, Rivian to hold. You think it's a good call?
I do, because Mary Barr's done a phenomenal job at GM. when everything was going great, when the economy is going great, when rates are really low, when employment's at the lowest level ever, you had a stock that sort of averaged around $50 a share. Now you've got the reversal. Sure, you have rates coming down, but you're seeing inventories build on the lots, and you're seeing the consumer also have some issues. So now that you're on the decline of that, and hopefully going to a soft landing, it makes sense that things aren't going to be as rosy for the auto companies. So they should decline. Rivian, frankly, I don't even know why they're still around other than keep getting handouts from the Saudis or somebody else. But those companies are just poor experiments.
Okay, we'll take a break. We'll come back with finals next. Let's do final trades. Weiss?
Yeah, Taiwan Semi, it has moved up, but I think it keeps going. It's above market multiple, but yet I still find it cheap because predictable earnings.
Yeah. Chips have been kind of squirrely.
I bought some SMH the other day for a trade. It's working out now until it doesn't.
Okay.
So it'll be a short-term position regardless.
All right. Kovac. Remember? Yes,
I
thank you.
thought
Amy,
he and his brother were
Amy,
talking.
before you say
So it's
anything else to get you in trouble, Kovac. Just remember that. I got you, Steve. Amy.
Is that his first name?
Amy.
I'm going to go with Regeneron. Obviously, they've had a lot of bad news in the last couple of days, and the stock's down a lot. But I think you very rarely get a pullback in this name, and longer term, it's a good buy.
AMT, American Tower, it's utility, and utilities are doing great, and people need more cellular power.
Okay, Joe T.
Train Technologies, TT.
Thank you, sir. Thanks, everybody. I'll see you on the closing bell a couple hours from now. The exchange begins right now.